So why would I sell puts on MSTY when that's exactly what MSTY does? Why even bother? And does it make sense to do so? Hello my friends, this is Legend. So I'm going to talk a little bit about selling puts on MSTY. Why I sell puts, and does it even make sense considering that's exactly what the YMAX MSTY does, right? That's their whole strategy, is an option income strategy. So they are, in essence, doing the option plays for you. Why would you be selling puts or calls on MSTY itself? So let's just take a look at it, and we'll look over at the trading chart and start this right off. Okay, so here we are on my trading chart, and as you can see here, I've got MSTY pulled up, and we've already talked about the move on MSTY, that it did move up from Thursday to Friday, a total of about 2.65% for the day. Very nice move. Love to see it. I hope to see more in the near future. But for today, we're going to talk a little bit about the options. And does it even make sense to do options on MSTY when that is exactly what they do, right? They do the option plays. So first of all, let's just look at the option chain here. Okay, so I've got that pulled up on MSTY right now, and we will look at the third Friday, which will be May 16th. Now that's not too far out, so we won't see much as far as the numbers for the premium and such, as far as them being high enough or not. So we may even move out for the third Friday in June. But for now, we'll just look at the third Friday for May. Okay, so as far as in the options, when MSTY does their options off their synthetics, we'll earn a distribution for that. And we get paid that distribution every 4 weeks, assuming that they get paid out the distribution. And that amount of the distribution would be announced usually on Wednesday. It goes X on that Thursday and payout for that Friday. Now, we do have the distribution will be paid out or announced this coming week on the 7th of May. And that's this coming Wednesday. They will announce their distributions, and it will go X on Thursday. So if you do not already have the shares, by the end of Wednesday, you will not earn that distribution. And then the payout will be that Friday. So as I said, we get paid that distribution for owning shares of MSTY of whatever they announce per share. And that is what we're earning off of their option plays that they have done over that period of 4 weeks. But I wanted to talk a little bit about how you can not only earn the distribution for the shares you do have, but how about earning premium for shares that you do not own but are willing to purchase at a certain price? And that is what we're doing when we are selling a put. And on this side of the chart here, we've got the puts, right? You can see right there at the top. That's the put side. All of this is the puts. This side is the calls. So for puts, we are selling a put. That means we will receive the premium for doing so. The premium is how much that you would earn for opening a contract at a certain strike price. So just to get some better numbers, I'm going to move this out to the third Friday in June. So that would put us at June the 20th. And that just gives us more available options with some premium in it, just for this example. Now you would pick whatever strike that you would want and whatever expiration date that you would want, and that is your choice. I'm just doing an example here. So as I said, the puts are on this side, the calls are on this side. Puts. What is a put? So a put is a contract that you are opening at a certain strike price for a certain expiration date, and you're stating that you are willing to purchase shares at that strike price at or before the expiration date if the price goes lower than your strike price. So for this example, if we just picked a number, and I'm just going to pick one just at random, I am not doing any kind of evaluation where it's sitting on the Bollinger Band or picking it according to that. This is just off the cuff number just for this example. So we will select $23 for our strike. And for that $23 strike, we are saying that we are willing to purchase those shares for $23 by June the 20th. So if that price goes below $23 on June the 20th, then we will be put those shares. And you can think of it that way because you're selling the put and you're saying that I am willing to buy those shares at $23, or I will be put those shares at $23 if the current price is below that $23 by June the 20th. Now, what if that price drops to, say, $20 on June the 20th? Well, I will have to buy those shares at $23, even though the current price is $20. Because the contract that I have selected is stating that I am willing to buy those shares at $23, no matter what the price is. Now, if the price is $23.50 or $24 or anything above it, then I do not have to buy those shares at $23 by June the 20th. It will just expire and the contract ends. I can then at that point sell another put if I would like to do so. So in this case, for that $23 put, now keep in mind also, if that price were to drop again, say that $20 example that we were saying, but we were saying that if it dropped to $20 at the end of June the 20th, on the end of that day, that trading day, then we would be purchasing those shares at $23. But what if it drops down below that $23 and it's only June the 1st or June the 6th, okay? Any time before June the 20th. What happens then? If it drops below that $23, does that mean that I automatically have to buy those shares? No, it does not mean that you will automatically be put those shares. Could you be put those shares? Yes, you could be assigned early, and that's what, if you've heard of people talk about being assigned early, and that's what it means. It means that you are being assigned that contract stating that you would buy those shares at $23, and at any point from the time you open it until the time that contract is closed, you are bound to that, right? So if that stock did drop to $20 and it's June the 6th, then you could get put those shares and required to buy them at $23. But that is only if you were assigned that, and the buyer would do so. Okay? Now, would the buyer do it? They could, and that's about all I can say is they could, but most of the time they do not. Normally, they are in more of a mindset of wanting more money, right? Because the lower that price goes down to $17 or $15, now I'm just throwing numbers out here, right? But if it went down to 15, they're going to get even more money, right? By June the 20th, if it's at 15, then they get even more money because they are on the other side of that put, okay? So you've got a buyer and a seller. I'm the seller, okay? I want to receive the premium, and the buyer has to pay the premium, okay? But I prefer to be on the seller side because I want to earn the premium rather than pay it out of my pocket. So yes, you could get assigned early, but 9 times out of the 10, the chances are you will not get assigned. But you should always be prepared to know that you could be assigned at any point that that stock price does drop below 23. But I have only been through an early assignment maybe twice since I've been selling options. So it does not happen very often, but yes, it could happen. So in this example, that $23 strike, what would I earn and what is the premium? Right? Well, the premium is how much I would get paid for opening that contract, right? Because I'm selling that option, and I'm stating that I am willing to be put those shares at $23. So for doing so, I will earn something between these two numbers, right? And I would select what I be willing to make off of opening that contract. So that spread here from $1.35 to $2.50. Now this is after hours, so the spreads could be a little skewed, but you get the picture here. So somewhere in the middle is usually what I go for, right? And they just happen to give you the mid over here of $1.92. So for that $23 strike for selling a put at a $23 strike, I would make $1.92 per share. Well, one contract is equal to 100 shares. Therefore, that $1.92 would be times 100 shares. Hence, I would make $192 for opening that put. And I would be on this selling side of that put. So I'm going to earn that $1.92 per share, or $192 for opening and selling that put at $23. And if that price never gets there and MSTY keeps on going up, then this $23 where it says $1.92, that will start decreasing. And at any point, I do not have to wait until expiration. I don't have to wait until June the 20th to close it. And I do have the right to close it. At any point, I can close it. So what I would do is I would buy to close because I sold to open. Then I buy to close because I want to get out of the trade, right? I can either ride it all the way to expiration, and at that point, if it never gets there, it just expires and nothing happens and the trade just goes away because it is worth zero money. But at, say, May the 30th or June the 6th, we'll keep that June the 6th date. So at June the 6th, this MSTY, say it goes to, I don't know, $30 or something like that. I earned $1.92. Well, that could end up dropping, right? This is the actual price of the stock, $25.14, right? So as that strike price gets further away, you can see the dollar values get smaller and smaller, right? Because close to the money, meaning it's right close to the current price of the stock, is $2.75. But if I go all the way to at a strike of 15, it's only 30 cents, right? So the further away I get, the cheaper it becomes. So therefore, if that price goes to $30, now my 23 is a good ways away from that 30. So that $1.92 may end up being closer to, say, 55 cents, right? And at that point, if I feel like I'm going to go ahead and lock it in, I can buy to close that position, that $23. If that amount now is, say, 55 cents, worth 55 cents, that contract, I can buy to close it for 55 cents. Now I earned $1.92 and I'm going to close it at 55 cents. So what does that do for me? What do I end up getting out of it? So the $1.92 minus our made up premium after the movement of the price to, say, $30, we're just going to say now that premium or that contract is worth 55 cents. So we get to keep the difference because we have to pay to close, right? We're going to close it early, and we're paying 55 cents per share to close it. What do we end up with? $1.37. So we make $1.37 off of the play. Now, what is the percentage that we actually made on that play divided by the $1.92? So that is 71% up on the play. Now, I don't know about you, but if it got up to that point of 70% or so in the play, and I've already gained 70% of that contract, and there's still, say, 3 weeks left, why not close it? Lock it in, and if it does peel back, well, guess what? I can sell another put at that point. But if you stay in it and it peels back and that price starts dropping again, well, that contract price now goes from 55 to, say, 80 cents or $1, right? It will move depending upon what that current price is. So that is something that you have to decide at what point you want to get out of it. You don't have to ride it to expiration. You don't have to. And a lot of times you want to go ahead and lock in your gains, especially if it had a huge move and now you've already gained so much out of that contract. Time-wise, it doesn't make sense to keep it. I hope that made sense. And I just wanted to let you know you do not have to ride it to the end. You can close early. So we've talked about a little bit about that $23 strike, selling that put. You earn that premium, and then you can either ride it out to the expiration date, or you can close early and you have to buy it back to close it at whatever that cost is for the contract. But you get to keep the difference, right? In a sense, you earned the $1.92 in our example, and we paid 55 cents to get it back. So you keep the difference. So that's kind of really the rundown there of the mechanics of selling the put and a little bit about premium. I know there was some questions about what is premium, so I wanted to point that out and give an example of that. You may have to go back and watch pieces of this because it is a lot of information to take in, but I think you'll get it if you watch it a couple times here. It'll sink in. So the main question was, does it make sense to sell puts on MSTY ETF when MSTY itself is in fact doing it for you? Well, the answer is it depends on your knowledge and what you want to do. So ultimately, it is your choice. You do not have to sell puts, right? Maybe you don't feel comfortable with it, or maybe you need to do a little bit more research on it, and that's all understandable, and that is something that you definitely should do. But again, maybe you just don't want to deal with it, and that's why you're in MSTY, because they are selling puts against Mr., right? The underlying, and for you, you just don't want to mess with options. And that's okay too. But let me show you what it could do if you do decide to sell puts. And always make sure that you do your research, learn how to do it, start small, but definitely know what you're doing before you get into any option play or even stock play itself, right? You should always know what you're doing before you get into anything. So to show what options can do for you, let's look at my spreadsheet. Okay, so here we are on my spreadsheet, and we've seen this a couple times here and there for sure. And what I wanted to point out, like I said on this one, is, does it make sense? Does it help you? And is it even worth it, right? To have the headache in some people's minds to learn options or to even mess with them, right? So right now I have the premium turned off, and you can see here I've got this little button here. It says no right now. So it is not showing any of the premium that I have sold puts on for MSTY. This is completely 100% my purchases and my distributions that I have earned from the time that I got in on August the 23rd of 2024, where I purchased 100 shares and so forth. Now, as you can see, the capital invested, well, whether I'm selling puts or not, that capital invested is going to be still the $10,000, because for selling a put, I do have to have the money in my account available to buy those shares at that put strike price, but it is not necessarily out of my account, right? It is still there. It's just being held. That is if it is a cash secured put. And for most people, it's going to be that. It will be a cash secured put. So that means your broker will secure that cash so that if that put does get assigned, that money is already available to cover the cost of that put. So it's not something that you would have to worry about as far as if you got to sign that put and then all of a sudden you've got to come up with $2,000 to cover that put. If you had a $20 put, in our case, our example was $23. So you would need $2,300 to sell a put, but they would have already secured that cash from your account. So you would not be able to necessarily use it, buy other stocks with it, or anything like that. It is locked up, right? So right now we're showing what I would earn with just my distributions. And with just that, my percent earned is at 65%, and my adjusted price per share would be $8.78 versus my purchase share average being $25.20. Okay, so that $25.20 is straight out the number of shares with the buy price and the amount that I've spent, right? Divided by the 400. That is my purchase share of average. And the adjusted average is taking into account any distributions, and we're not putting premium in there, so it's just distributions. So at $8.78 is what my average is, and that's my real average, because my distributions need to also be added in on this deal, because that is money that I am making. But the big question is if I have sold premium and I've sold options here, in this case I've sold puts and a few of them, right? Not a whole lot, but a few of them. What does that do to that adjusted price average? Well, when I turn this on, it will generate and it will plug in my premium earned into this column here, which will then adjust my price per share. So $8.78 becomes a new number once I add in the puts that I've sold and the premium that I've earned for doing so. And as you can see here, and you probably won't see the total, but I will tell you that total right here is $679.09, and you will see that populate into this premium earned once I turn this on. And it's just simple little drop down button to click, and I click on yes, and now it plugs it in. We got $679.09. That is the amount of premium I have earned in this position. What did that do for my average price per share? It took it down, and it took it down a good bit, right? It took it down to $7.08 from the $8.78 that it was previously. So we dropped $1.70 per share in price just from selling options. And honestly, it's not a lot of work to do so. But do keep in mind, you do need to know how to sell options, as you could lose money by doing so. And I have to throw that out there because that's always a possibility anytime you're involved in the market. You can always lose money, whether it's price appreciation, price depreciation, NAV erosion, puts being assigned, current price dropping to the low. You never know. So as you can see here, we actually dropped $1.70. So for me, yeah, premium and earning that premium is well worth it for the little time that I have to put into doing this. And as you can see, it's the same two options that I've had. All I have been doing is moving that strike on down as MSTY was going down in price. Because originally it looks like I had it at about a 25 and a 24. And then I rolled them several times, right? That 25 went from 25 to 23.50, and then 23.50 to 23, and then the 23 down to 20. And each time I rolled it, I was reducing my risk, right? Because I originally had it at 25. I rolled that $25 put all the way down to $20 and earned money by doing so. But instead of me owning shares at 25, now my strike is at 20, and with the current price at 25, I'm looking pretty good and pretty safe on that one for now. Now granted, my expiration date is July 18th, so it's got until then to move, and since there's so much time involved in that, I don't necessarily want to close it because I will not make much off of that position, that single position there. So I will give it some more time and let it stew and simmer, and we'll see what it does when time gets a little closer. And same thing here with the $24 strike, right? I rolled it from 24 to 24 down to 23.50, and then 23.50 down to 22. So, and like I said, each time I was making more money, and I made some good premium, right? And you can think of selling that put in a way of earning that premium in place of the distribution. And that's the way I look at it. And I don't even have to own the shares. So I don't have NAV erosion, because if you don't have the shares, you don't have NAV erosion, because you have to own the shares to be part of the NAV erosion, meaning that the price is dropping, but you own the shares at a higher price. Well, I don't own the shares. I just keep rolling it around and earning premium. And keep in mind, I am not saying that I could not get caught and then have to purchase the shares at a certain price. But as you know, I'm willing to buy shares of MSTY at 20 bucks for sure, if I was ever assigned those shares. So I think I've pointed out quite a bit here. And I think I've pointed out that, selling puts, earning premium is worth it, but always make sure you know what you're doing before you go to do so. So there are plenty of videos out there of people really walking you through. And I have some as well where I've gone through and explained it, but it doesn't hurt to get other people's perspective on it as well. So if you're interested in this spreadsheet that I'm showing right here, I've had a few people who have downloaded it, are enjoying it, and it is much appreciated. And I appreciate each and every one of you who's helping to support my channel. But if you're interested in getting a copy of this spreadsheet to where you can fill in your positions, then you'll be able to see a link in the description, and there will also be one in the pinned comments at the top where you can click that and you'll be able to get your copy of this spreadsheet. And this is a Google sheet. It will come in as a view only, and you'll just make a copy. And there will be also instructions on how to make your copy once you download that Google Sheet from the link that you would be provided. But whether you use my sheet or you use a sheet that you have, please make sure to keep track of that adjusted price per share, especially for these YMAX ETFs, for any of them that you may have. And you could just make a new tab, call it PLTY if you have PLTY or anything else, right? But especially on these high yield ETFs, you really need to keep track of that adjusted price per share, because once that adjusted price per share gets to zero, then I will have earned all of my capital back, and therefore all of my distributions or any premium that I would earn from that point on will be free cash in my pocket. And I don't know about you, but there is something about getting stuff paid off and then just having that passive income of those distributions that MSTY can provide. If this would continue, that just would be awesome. So I think I'm going to wrap it up right there. Don't forget to subscribe, like, and share this video. It'd be much appreciated. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, legend out.